All right, let's get right into it. What a day. After a week of some really intense pressure, Asian markets just staged a massive comeback today, March 10th, 2026. We're going to break down exactly what happened and, more importantly, why. Okay, let's dive in.
I mean, what a difference 24 hours can make, right? Just yesterday, the KSP absolutely cratered by nearly 6%. Analysts were saying the fear levels were higher than what we saw after the 2001 terror attacks. And today, a total 180, a surge of more than 5%, one of the biggest single-day rebounds we've seen in a long time.
So the big question is, how on earth does a market go from the edge of a cliff to a massive rally like this, basically overnight? Well, we're about to unpack the key drivers, everything from geopolitics to the psychology of the market, to really understand what just went down. To get this story, we have to start not on the trading floor, but on the world stage. The immediate thing that kicked this whole rebound off was a huge shift in geopolitics. And this wasn't just a Korean story. It was like a tidal wave that lifted markets all across Asia. You can see the KSPI and KSPI 200 just took off, really powered by a huge recovery in semiconductor stocks. But at the same time, we saw solid gains over in Hong Kong and Shenzhen, all thanks to tech and stabilizing oil prices.
So, here was the trigger, the one thing that lit the fuse. An announcement came from the US administration that basically signaled its objectives in the Middle East were wrapping up. That single statement acted like a massive pressure release valve, instantly taking all that war risk uncertainty that's been crushing the market right off the table.
You know, this isn't the first time we've seen something like this happen. There's actually a name for it. Analyst Ken Fisher calls it the Wall Street Waltz. The idea is that a war shock creates this bottom based on pure panic. But as soon as that immediate risk goes away, the market doesn't just climb back. It snaps back hard in a sharp V shape. And that is exactly what we saw today.
But look, geopolitics was only the spark. To really get a grip on the speed of this turnaround, we have to look a little deeper at the forces that make the market act less like a cold calculator and more like a social thermometer. There's this theory from economist Gunter Dueck called behavioral hysteria, and it just nails what we saw. Basically, the idea is that in our super-connected world, collective emotion can totally steamroll rational analysis. We saw it on March 9th. I mean, you had a rock-solid company like Samsung, which had just posted a 14-fold jump in NAND profits, getting sold off just because of this wave of collective fear. And the reversal? It was just as emotional. The feeling of relief was so intense that just 6 minutes after the market opened today, they had to trigger a buy sidecar. That's a kind of circuit breaker just to handle the flood of people trying to buy in. It was a textbook case of panic selling followed immediately by panic buying. But this emotional rally was poured on top of another powerful story that was already bubbling up in the tech sector. It's a concept from valuation expert Aswath Damodaran called corporate rebirth, and it really helps explain why certain tech stocks didn't just rally, they absolutely exploded higher. And this slide is the perfect picture of that theory at work. Look at Samsung and SK Hynix, up over 8% and 12% today. The market isn't looking at them like old, boring, mature companies anymore. Because of these huge innovations in AI memory like HBM4 and on-device AI, investors are now seeing them as reborn leaders in a brand new AI supercycle. Their value is shifting from what they own now to what they could become. Now, let's talk about another huge piece of this puzzle, currency. As that geopolitical risk just vanished, the Korean won started getting much stronger against the dollar. And this is where a concept from George Soros called reflexivity really kicks in. So think about it like this. It creates this powerful self-reinforcing loop. The feeling of lower risk makes the won stronger. Then, a stronger won makes Korean stocks look like a bargain to foreign investors. So they start buying, which pushes both the stock market and the currency even higher. You see the cycle? So, after a crazy reversal like that, the million-dollar question is, what's next? We've talked about the human psychology side of things. Now let's turn to the hard numbers and see what the quantitative models are forecasting. Now this isn't just someone's gut feeling. These forecasts come from some really advanced models. You've got Garch models to measure how long this volatility might stick around, VAR models that look at how things like oil and stocks affect each other, and simulations that try to predict future market conditions. And a huge takeaway from all that modeling is this: buckle up. Just because the market's direction has shifted up doesn't mean the roller coaster ride is over. The models are saying we should expect this high volatility environment to stick around for several more weeks, so we prepared for more big swings. But here's the interesting part. Even with all that expected choppiness,
The overall outlook for the next month is incredibly positive. The models are actually projecting double-digit gains for Korea's main indices, and they expect strong follow-through from tech stocks in Hong Kong and Shenzhen too.
In fact, the models are pointing to something pretty incredible. They're projecting the KSP could actually challenge the 6,000 level as soon as next month. That would be a huge, huge milestone.
Okay, so you've got this forecast for big gains, but also high volatility. How do you even think about navigating something like that? The source material we're looking at lays out a few systematic frameworks. Now, it's really important to stress, this is purely for educational purposes, to help us understand the logic behind these kinds of strategies.
All right, first up is a strategy called volatility-based momentum. The logic is actually pretty straightforward. First, you use a model to confirm that the market has a high probability of being in a growth state. Once you've confirmed that, the strategy just focuses on the assets that are already showing the strongest upward momentum. Things like KOSI 200 futures or those leading semiconductor stocks we've been talking about.
Here's a more advanced idea, a pair trade, and this one is built on that corporate life cycle theory we talked about. The idea is to identify a rebirth sector, like AI semis, and at the same time, find a sector that's in decline. The strategy is to basically bet on the growth sector while betting against the declining one, trying to profit from the gap between them as it widens. So, to wrap this all up, today's incredible rally wasn't just a random fluke. It was the result of three powerful forces all coming together at the perfect time. The massive technological trend of the AI supercycle, the sudden relief from geopolitical pressure, and a foundation of stable energy prices. It was a perfect storm, in a good way.
But all of this points to a much, much bigger question for the future. Today's rally was fueled by AI companies. As this technology keeps rewriting the rules of our entire economy, we have to ask, how is it going to permanently change the relationship between capital, labor, and the very nature of market cycles themselves? That's the big story we'll all be watching. Thanks for joining us.